Okay, so stepping down for my 821 USD Canadian dollar a week ahead, so to speak. This is it's Friday. Markets are going to be closed until about Sunday evening when the Asian markets open, and then followed by the UK and some of the European markets early morning, the next morning, and then the whole week starts. So ultimately, this is a week ahead type of view from 821, and I just wanted to jump down. I looked, if you followed my or looked at my other videos for the same date range or date of 821, you would notice that I went from a weekly, then a daily, down to a 3 hour, and looked at a few different tools and options, and then this sort of hones in a little more and becomes the final tactical entry decision time frame. I've already determined the direction where I want to go. I've already virtually at a higher level determined my entry point. Now I just wanted to zoom in on the entry point side and determine, okay, so is this really what I want to do as far as my entry point, and is there anything else that the chart on a zoomed in level would tell me? And there's a few things. The 15-minute and the 30, I use both of them. Looking at the 30-minute, you'll see it says sort of the same thing, obviously just about half as much detail. But I'm going to use a 15-minute. It's one of those things where subconsciously I go with the feeling a lot of times, and also I go with the structure, but then there's some feeling sometimes where, the subconscious feeling, you've been looking at charts for so long that it's just this one for a few different reasons. One of the reasons is it gives me a better view of the technicals, and I just want to point out here that you could see on the technical basis, or excuse me, on a shorter term, it's like a flag formation. But this looks very, very familiar to me. This looks just like what they call a leading fifth formation. But you could see that you basically have a jolt upwards here, and then you have, and I'm going to do a quick down and dirty. It's almost like a flag consolidation or flag formation, and you could see right here, and I'm doing these with a no mouse. It's one of those mouse pads I'm actually working on at the moment, unfortunately. But you can see that basically we're hitting the top Bollinger Band up here. We have overbought, highly overbought relative to the time frame on the stochastics RSI, and you could even look at it from almost a like a short term, even though this isn't as reliable on shorter term time frames, it still does play out a lot of times. But you got a flattening, and this is very, very, very. This is not that defined as a normal technical divergence. We got a flattening right there of tops, almost like a double top, except on an oscillator, it's a stochastics RSI. And then you also, as you can see from my upward sloping trend line, you got higher highs. It's making higher highs basically on the trend line. So that's technical divergence without a doubt. And then you got one last boost upwards with one intraday 15-minute candle boosting up towards the end of the trading days, yeah. And then basically I expect this formation, I believe it's called the leading fifth from a technical or from an Elliott wave theory point of view. But this usually will, it's like an A, B, C, D, E, or A, B, C, D, E, and then I think it does one last jolt upwards, and then it comes off to basically come down all the way to possibly, I think, the 76% level. So we could see it come down as far as, here. But honestly, we got different, and these are things that when you zoom in, you sort of see. But we got, let me see here. I wanted to just look at you always look at historical support levels, because wherever the consolidation zones tend to be is where the groupings of people tend to remember the groupings. And if you look there, this was actually a level I was eyeing earlier. There were two levels, and if I went on the higher level time frame, there was basically the 1.3150, and then there was the 61.8, which was just about at 1.3120. Now, seeing this formation, and basically seeing the what they call leading fifth, and it's almost like a fake out. Like a lot of people, if they just put a resistance level right there, and they see, oh, it broke out above the resistance level, they would probably be sad to find out that it's gonna, you could see how overbought it is here, and they would be hard pressed when they go to buy, and then the thing just drops down. Now, another level that you could sort of see here is if you go over here, you got a pretty strong level right there, but it's one of those things where it's gonna retrace. I'm confident of it, and it's way overbought here. I'm thinking we're gonna at least hit the it is where stops and limits and money management come into play. But I'm confident we're gonna come down to at least the 38% level, and in this case, I would be more prone to. There's two options that I would take. As I mentioned earlier, well, I'll talk about this option first. I would take either doing a one cancels the other at just a hair above about 1.3155, just a hair above that, sort of like a intermediate psychological level, 1.35, because it's a round number, just a hair above that, and I would put a stop relative to my profit target. So in this case, if we're going for that 1.35 profit target, and this is just more of a tactical entry, but we're not going to place our stops at 10 pips, relative to our entry. It's just zooming in. Our pip level is going to be a 3-to-1 profit loss. I think a 3-to-1 profit loss is going to put us right around this area. So let's do the math. If we get in at 1.3150, we're going to shoot for, say, 1.345, or excuse me, 1.3495. So that's about 345 pips. And if we take 1/3 of 345 pips, that's going to put us at 345 pips divided by 3 is going to be 115. So if we take 115, and we'll have to subtract it from our entry level. Our entry level is going to be 1.3155, a hair above that 1.3150, right? And we're going to minus the 115, right? Or excuse me, 1.3155 minus, and it's going to be 0.0115, so 115 pips, equals 1.304. 1.304 is exactly right here, and that is, it's funny, it's right at that Bollinger Band level, but that's just a coincidence most likely. So that's a good level because you see all this consolidation. If we're shooting for a high target of 1 point, or it's not, relatively high, of a 300 some odd pip range, 350 pip profit, it's no surprise that we're going to want to put our stop low enough, because you can't expect to have a 16-to-1 profit loss ratio. If you want to make 350, 400 pips, you cannot only risk 10 pips. Short run, you might get lucky, but long run, transaction costs are going to backhand you out of this. So basically, it's a good level, because this consolidation area is going to naturally serve as a support level if the thing is to bust through your 1.3150 level, shoot down. This is going to provide you at least some cushion of support before it breaks down here. Now, another option is, since we looked at this 61.8 level, you could place 50% buy, or 75%, or 25% buy at the 38.2, and then you could do the other percentage out of the 100 of how much capital you're going to risk. I would not recommend risking more than 5 or 10% of your trading income or capital. But if you put the other percent here, you just calculate the portion of the profit that is going to be. So say you put an X amount trade, you put 50% here and 50% there. You're going to want to adjust the 50% pip profit loss down by the amount for this trade. So it's going to be lower for this one and obviously higher for this one. You get the point if you do the math on paper in Excel. And then the last option, if you feel that it's going to possibly blow through these if it goes down, or if it goes up, it's going up, then you could always do a buy stop order, or one cancels the other buy stop that then does an automatic limit, or I think you could do like a trailing stop. But basically you're doing sort of weird because you're doing a buy stop above the market, and rather than protecting a previous short by doing a buy stop, which covers the short if it is to rise up and go against you, you're actually doing that with no previous position. So you're actually using it to enter a buy rather than hedging. It's weird, but it works. You place it right above the previous psychological resistance of 1.32 with the conviction that if it goes through that level, people are going to see it and they're going to be like, well, that's a strong level, it made it through, I'm going to hop on and buy, and then it just naturally propels you upwards. That would not be that bad of an idea, or you could have a percentage of your order to do that. It's all up to you, but those are the options that I would personally take in this specific trade. Thank you.